Hello and welcome to the Telegraph Studios, where I'm joined by Alexandre of Murex, where we'll be discussing the changes in regulation and risk management in the financial sector since the financial crash. Alexandre, hi.
Hi.
It's been a few years since the financial crisis. What have been the biggest changes in risk management and regulation since then?
Well, the crisis has truly been a wake-up call for risk management in capital markets. Firstly, institutions understood they needed to develop a risk framework which is holistic and much closer to real time for managing their exposures. And second, they had to deal with a massive wave of regulatory rules which are enforcing stricter risk management practices. These basically bring us to a much more resilient framework, but also are seeing the erosion of profit margin for banks.
So how do organisations cope with these changes?
Well, I'd say the first reaction often is to see it as a burden, especially the cost of compliance in a regulatory environment that has been in constant change since the crisis. But there is as well an opportunity in that investment in infrastructure and organizational setup can be leveraged to deliver a more resilient framework and improve and restore profitability through new business models. You have highly complex upcoming regulation pieces like the fundamental review of the trading book, which are requiring significant investment into infrastructure. You also need to bring down the risk IT costs under control by materializing synergies. So institutions are investing in developing their data management processes and building up data aggregation and risk reporting capabilities. Now, beyond regulation, I think the most striking trend to me stems from the realization that credit risk, liquidity risk, and capital are now the main drivers of profitability in capital markets. So institutions are investing in reshaping the organizational model, breaking down the traditional trading silos to manage those risks more efficiently and centrally. And the idea is that institutions that will move to a risk-based pricing organizational model will enjoy a significant competitive advantage, as they will be able to identify more easily profitability areas and optimize their capital charges and collateral allocation, for instance.
What is the best strategy to take on these challenges?
I could sum it up in two phases: consolidation and optimization. Consolidation to reduce costs and bring up the efficiency of the classical risk management operations. Optimization to move to a more risk-based organizational model to restore profitability. The first phase really is about consolidation of business lines, processes, and systems. Then on to the second phase. The purpose is to reposition and optimize their resources. Non-profitable business lines can be shut down or shrinked or even outsourced. And where synergies are identified, business areas can be regrouped to bring more efficiency. A good example is the emergence of central collateral trading units, which are merging the margining operation of previously independent business lines like central clearing, securities lending, listed products, or uncleared OTC derivatives. At this stage, the institution can develop efficient risk optimization strategies like pricing on a pre-trade basis the cost of collateral to choose the cheapest clearing execution venue.
So how ready are the banks for this? How advanced is the process?
Well, most of them, I'd say, are still struggling with two main technology challenges. The first one is the rationalization of their IT infrastructure, which means they need to move away from a fragmented landscape of applications to move activities onto, I'd say, broader integrated risk and trading platforms. The second one is they need to work on delivering to the business this new risk calculation, and that can be quite a daunting computational task. CVA, for instance, might require running Monte Carlo simulations involving millions of repricing in a matter of seconds. This is why I think we are seeing now a trend amongst financial institutions who are turning to technology providers to help them define a long-term infrastructure strategy and work on putting it in place in a less disruptive manner. Murex is typically seen as a very credible partner here, as we have been advocating the single integrated platform for risk, trading and operations since the early 2000s.
It seems to me that the financial world is a constant state of change. I mean, what are the strongest trends you can identify at the moment?
The first one is obviously in the investment in technology that we were mentioning. Another one is the fact that market participants want a risk management framework that is, one, highly evolutive and adaptable, and two, fully real-time enabled. Finding an organizational setup and the technology that can adapt to future regulations is very high on their agenda. And here, technology should become an enabler rather than being the obstacle it has been in the past. For the second point, the objective is to build a much more reactive risk framework across the organization. A last trend, I think, that we are going to witness is the redefinition of the collaboration model between banks and technology providers. We are clearly moving away from the old paradigm of vendor versus buyer. And here again, I think Murex is actually very well placed in that new model, since firstly, we are very well known for our culture of building long-term partnership with our customers and accompanying the transformation of their capital market infrastructures over years and decades. And second, because we have been investing about €1 billion over the last 10 years into MX.3, which is our integrated risk and trading platform. So we are very well positioned to deliver the cutting-edge analytics, real-time risk technology, and interoperability solution that the market is looking for.
Alexandre Bon from Murex, many thanks.
Thank you very much.